Hello, everybody. My name is Daniel Young. I'm the owner and founder of Adapted Perspective. I believe it's my purpose, my calling to help you identify your dreams and help you reach your financial freedom destination and maintain it so you can pass your wealth off to the next generation. If you've seen any of my past videos, you understand our investment strategy using closed-end funds. And understanding that strategy is key because I'm going to apply that strategy towards sifting and filtering out financial memes. And most of the memes are trash, though I have found some decent ones here and there. Reminders, this is an unedited video. I mean, who knows what you'll hear in the background as I film these in my house. And if I show our strategy of using closed-end funds, I will briefly explain that system before transitioning back into this meme review. Disclaimers. See the description for the disclaimers. The only one I'll mention here is that I am not a financial advisor. I am a financial strategist. And normally I would be transitioning into reviewing a meme. But this time I'm going to show you the prep work that I do when I review certain types of memes. So I've already screened the funds. I've already figured out which closed-end fund I'll be using as a comparison. And then I'm showing the rest of the process to give you just additional insight. So allow me to share my screen and we will hop into this. So need to move this bar, I think. You get to see my notes. So this is my Facebook, or not Facebook, this is my Pinterest page. My YouTube, Pinterest, and Facebook channel all have the same background. If you go to saved and then come over to income memes, all of these memes are what I'm working on for these videos. And the meme that we're looking at now is this meme. Now I'm going to get into this meme and then reference this video in the meme or in that video. But for now, I actually want to break down this content and how I go about that. So I've already started that. I've done this before for other comparisons. So we own this closed-end fund. So pretty much took the same layout and spreadsheet I had for a different one and remade it into this one. So we own this closed-end fund. There are 5 individual stocks listed here: Coke, Pepsi, McDonald's, American Express, and Disney. And when I sifted through all the holdings of this fund, I found 4 of the 5. This one says American Express. This fund and many others, I haven't found many American Express holdings within closed-end funds, or at least of the ones that we own. There's a ton of MasterCard, there's a ton of Visa, couple Capital One, not American Express for whatever reason. So in order to break this down, we need some more data. So if we come over here, so we'll get to this in a little bit. But what I want to look at now is how to fill in this. So I've reviewed Coca-Cola before. It pays quarterly. That was the cost of one share, but we need updated info. And I like this website the best for free info. Eventually, they're going to ask you to fill in some free newsletter information because I want to say it's 6 searches a day. Then you have to apply to be a free member, and then you get more searches. But I like their platform the best. Click on the graph, and we're looking for open price 60.28. It pays quarterly, pays that dividend, still the same yield. So you'll, well, not the same yield, but at any rate, pays quarterly, pays that amount. That's what it works out to. If you take that dividend and multiply it by 4, because it pays quarterly, that's what it'll pay you a year. That's why. Annual yield. So if we take that dividend and divide it by the current share price, you get a 3.05% annual dividend. Now it says, the meme says, invest 5,000 in these stocks. And you could say maybe it's 1,000 in each, but we're just going to use 5,000 for each. So if we invest $5,000 into Coca-Cola, we're going to look at whole shares, not partial shares, whole shares. So we can do that by putting it in equals. We take the value, divide it by current cost to share. We can look at how many shares that is. So that's partial shares, right? So we want whole shares. So we can't afford 83. So we put in 82 dividends off the 5,000. So that's the annual dividend. So there's a more complicated way to do this, but the easiest way is just to take your total shares times the annual dividend, and you'll get the annual dividend. Sorry, total shares over the annual dividend of one share gives you the annual dividend off all of your shares, right? And then this will come into play later. So let's look at Pepsi. I'm not a fan of this little pop-up thing at the bottom. Yep, and it's back. Stormy day, slightly slower internet. Still working. Come on, Pepsi. Come on, Pepsi. There we go. So it opened at 185. Let's see. Pays a quarterly dividend. So we can drag that over. Cost of a share, I believe, was 185. None of these things apply to single stocks. Dividends, 1.265. Pays on a quarterly scale. So this cell is for quarterly scale. So I can just copy that to the next and it'll automatically calculate. So equals 5,000 divided by that number, but it's whole shares. So 27, right? And that's already rigged up like we want. So we get that. Now we have two numbers. This is auto calculated to be the sum of those numbers, right? And then we're looking at the overall, the average yield across those four categories. McDonald's. McDonald's pays quarterly. McDonald's is 295.11. 295.11. Those don't apply. The dividend 1.52. We can update that cell. 5,000 divided by that amount. We get 16. Can't do partial shares, right? We're not going to round it up. So we only get 16 shares. But then we can do the same thing. Now, we're going to see what Disney is, but our overall yield is currently not meeting the demands of inflation. So unless that's just an outstanding yield, this yield is going to be below inflation. So you're going to lose money on this portfolio simply based on the devaluation of money alone. But we'll look at Disney. They pay semi-annual. Ooh. All right, so it opens at 90.11. And did I close out? That's strange. All right, 90.11 and semi-annual. So semi-annual, 90.11. We can still use these, right? This is getting ahead of myself. All right, the share 0.88. We can still use these formulas, right? So see, it's guaranteed for 4. So when we drag it over, we're just going to change the 4 to a 2. That's just a number, like it's not a formula. So if we drug it over, it would give us the same thing, but we don't want that. So equal total investment divided by current price of share. We're not going for partial shares, so it's 55. This is rated on, let's see, 15 times 13, total shares times annual dividend. That still works, right? So if you invest in this suggested lineup of funds, which we can even look at the dividend of this other fund, American Express, AMX, I want to say. See if I'm right. Nope, not. So we come over to here and go American Express tick AXP. Oh, so far off. AXP. We're not going to put in the data. We just want to see the actual dividend. They pay one. Oh gosh. So look at that yield. So crazy price, quarterly dividend, right? Really low yield. So in comparison, it would bring this down further. 1.37 is lower than anything else here. So it would drop that more. So on inflation alone, you are losing money with this portfolio. Now, let's compare the same thing with this one closed-end fund. So this one closed-end fund, funds operate with fixed shares. When Coca-Cola, or if Coca-Cola ever runs out of shares, they can simply pluck one from out of thin air, write you a share on a sticky note, and it doesn't impact the value of the rest of the shares. Closed-end funds have a limited number of shares. It's a closed system, and it's very regulated by supply and demand. When demand goes up, right, available shares go down. That makes them more valuable. When there's a ton of shares out in the market, it devalues them, right? And it's a smaller corner of the market, so it fluctuates more because it's a smaller corner of the market, but it also allows us a much cheaper buy-in than the well-known part of the market. So if you put um, some of C8 to F8, man, $600. That does not seem like it would be $600, but it is. C, D, E, yeah. So to get just one share of all of these 4 companies, it's going to cost you this amount, right? Versus just one share of this fund is $5. Well, a little bit more than $5 right now. So if we take the same system, right? So closed-end funds you can buy at a discount to their overall value. You don't get that with single stocks. So what I do on our closed-end fund portfolio and all the different data is I take all 438 closed-end funds on the bottom. 440 minus the 2 lines at the top is 438. Current yield across those 438, which some pay a dividend and some don't. right? Some pay a crazy high dividend, some pay a really non-existent dividend, or just no dividend, is 8.64. That's a lot higher in general than 2.34. So what I do is I go through and I sort all the funds. I update this every month. I update every single fund every month. So if there's a new fund, it gets updated. If there's a fund that gets bought out or liquidates, it gets taken off. And I go through and I categorize everything. Dark gray doesn't meet our parameters. Light blue is what we own. Purple, which you'll see in a sec, is what's recommended. And it actually gets updated every time I update this. Olive is what we're interested in, and white, it honestly falls in the gray area. We're not tracking it for any number of reasons. Um, so I update this whole thing every month, and I update every targeted fund. So every single double or triple asterisk every single week. Excuse me. And then I come back and I can sort them based on overall discount. And I can sort them based on how we target things. And then I film videos about what we're targeting and what I would pick if I'm investing my money or our money. So this was this past week's. And I'm not going to review that video here because it already has its own video, right? So we own this fund. Based on this video, I would buy more of this fund if it's me, right? So historically, we can look at the overall discount of the fund, and GLO has a pattern. It goes up and down. So based on your strategy, you can buy it low and sell it high. You can dollar cost average when it's low. Really kind of up to you and what you want to do. Historically, it's above its average, its discount. And based on the last 5 years, it's above. This was a couple days ago. This is current data. It's still close to double its 5-year historical. It's close to double of its 5-year discount. So historical discount alert. Yes, like a wonderful time to buy. Current dividend. They used to pay a higher dividend, but they lowered it based on the current market and the Federal Reserve rates. So since we're going to invest, or we were advised to invest 20 grand across these 4 funds, we're going to use that number as the metric here. So the number of whole shares, right, which it says 5 grand because of these, but in this case, we're using 20 grand equals 20 divided by the open price for today. Oh, we don't want that. So 3,921. The difference in this dividend compared to the others is this one pays monthly. So it doesn't look like much, right? It's really small compared to all of this stuff, but it pays you every month. So if we did that by quarter, pull up a calculator. So we'll use Coca-Cola. They're always my guinea pig. So 0.0483 times 3 is actually that per quarter, right? So it still doesn't look like much. But since the share price is so low, we're able to buy a lot of it. And then we get these funds inside of their portfolio, plus we get 150 other funds. It's very much a portfolio in a can. It's crazy. So the annual dividend off of that, right? So it's the same idea. It's still that times that. So we can take the same formula and apply it backwards. And that's our annual dividend. And that's an 11% dividend, which sounds crazy and absurd. But I'll tell you it's real. And I know it, one, because I've done the research and I follow the people who say it's real, and then we invested in it. And the just insane dividend you can get on closed-end funds is real. So you get a cheaper buy-in. You get Diversification through the funds diversification. So instead of you, I mean, that's the same idea. Those are both consumer goods and drink suppliers. That's not diversity. That's a consumer good. Um, you could argue that it's food in addition to just drink, but it's kind of the same thing. Disney is its own thing, right? But instead of you buying all of these things and diversifying your portfolio through single stocks, now you're letting this one fund diversify its portfolio for you. So you get access to all of these different things through just one fund. And it's a heck of a lot cheaper than these four. And you actually get it for a discount, like you're buying it for less than what it's actually worth. You're getting an insane yield on that buy-in price, and you're able to buy a lot more of it. And you end up with this amazing dividend. Now, if you sell the fund, like if your goal is to buy and hold, right? As it does this, you collect the dividend. If your goal is to buy it low and sell it high and repeat the process, that's fine. You collect the dividend the whole time. Um, but in the end, for the same amount of money, right? Now we're getting three, four, five times the amount you would get through this diversified portfolio by just investing into one portfolio. Closed-end funds are, I mean, they're beholden to how they're set up. There are um, closed-end funds that invest in oil, natural gas, energy transfer, renewable resource. There are uh, real estate investment trusts. There are uh, funds that do, um, say, metals and minerals. There are funds. There are a variety of funds to meet your needs. If you want to just select, we own a fund. We own currently five oil, natural gas, energy transfer, renewable energy funds. They invest in companies that do that, and we are diversified through that sector, right? So we're diversified through that sector, but it's all one thing. Like if we look at it as a pie, versus GLO is diversified into everything. We could have oil and natural gas as a section. We could have real estate investment trust as a section. We could have corporate bonds as a section, right? Versus GLO does everything. So and I'll do a separate video. I have another one coming up too. I'll do a separate actual video as a review of this meme using the data that we're talking about now. But that's why you have to do the research. And I mean, that fits me in what I enjoy doing. I love comparisons. I love looking at the data. There we go. Because it's like invest 5 grand in these stocks and you get how many shares, which who knows when this was done. You get these dividends. Well, that's great. You know, are you invested in any dividend paying stocks? Do you want more dividend paying stocks? Well, yeah, but if you really look at the numbers, like I say, it's bad advice. If you're doing stuff with single stocks, it's generally bad advice. Um, People will use Warren Buffett as the example. Buy what Warren Buffett buys. Okay, well, what Warren Buffett has in his portfolio, maybe he bought it when it was $5. So let's go back here. So if we use this just as the example, this is the existing data. Okay. So off this one fund, if you buy it at that level, right, you get this dividend, that's your yield. Yield just means you're taking the overall dividend and dividing it by your buy-in price. That tells you your dividend payment or your overall yield. So if we buy at this and they suddenly decide to raise their dividend, they raise it to 8 cents. Oh, gonna I changed the wrong one. That's why. If they raise it to 8 cents, then it changes our overall yield. So if we buy it and we hold it years, and they slowly increase their dividend, then we're getting a better yield off our buy-in price in the current dividend. Okay, that's Warren Buffett. Warren Buffett bought stuff really cheap. So when he looks at his things right now, he's getting an amazing dividend off his original buy-in price. Versus us, if we buy it at that higher price, buy an American Express now, you're going to pay $175 for it and get this dividend and get this crappy reward for owning the company. That doesn't behoove us. It doesn't help us. If inflation is right now, inflation is 4%. You're losing 3.63% a year in devalued money by buying this company alone. But if I come over here and I buy one company, that this company doesn't own American Express or Amex, right? But just Coca-Cola, Pepsi, McDonald's, or Disney, by owning this one company, we're getting this payout. So even if inflation is 4% a year, we're still getting a 7% annual dividend or a 7% reward for owning the company. That's a much better long-term game plan than single stock. So I need to stop my share. If you like the content, consider subscribing to my channel. Also, head over to Facebook and join my group there called Navigate Your Finances. The link will be below. And then remember, you're the captain of your ship. You have the power to change your life and your financial future. Many people will offer to help you. Like the meme we've been talking about, many people will offer to help you, but only you can make the choice to do it. Make sure you know what you're doing. Make sure you actually know and understand the system that's being advertised and encouraged and suggested to you. There are countless financial means, and the vast majority are all honestly really bad advice. So if you're going to take that advice, please be sure you know what you're doing, because at the end of the day, it's your decision and you're the one responsible for your decisions. So whatever you're working, right, whatever you're doing, whatever dreams you have and whatever you're working towards, just make it happen. Shock your world. It is far easier than culture tells you. It is far easier than society tells you to make your dreams a reality long before you retire at 65 plus, right? And if those dreams, it's not so much if those dreams were possible, but if those dreams could have happened on their own, they would have happened on their own by now. But since they haven't happened on their own, you're going to have to change your strategy and you're going to have to make that happen. If you really want to fly a hot air balloon across country, or if you really want to completely redo a classic car, or if you really want to retire before you're 50, you're going to have to make that happen because it's not going to happen on its own, right? You're going to have to change some things. You're going to have to strategize, and you're going to have to make that happen. So make it happen. Shock your world. This is Daniel Young signing off. I will see you on another video. Bye-bye.